What's going on? Alex here, and today I'm answering your tax questions from YouTube. That's right, you leave questions in the comments, I answer them in a video. It's a beautiful thing, so let's take a look. This question comes from Hunter and goes as follows. As a follow-up to the capital loss carryover video, I did a video about capital loss carryovers a little while ago, I would be interested to see you do a video about net operating loss carryover for a sole prop rental business. For instance, if I have a net operating loss in a year for my residential real property rental business, how do I carry the losses forward? My understanding is that the loss carries forward until you sell real property for a gain, in which case you can use the suspended loss to offset a gain on the sale of the rental property. My further understanding is that you count the NOL against your W-2 or 1099 income in the year of the loss if 1, you're an active material participant, which quickly phases out once you have 100K AGI and completely phases out once you have 150K AGI if you're married filing jointly, or 2, you meet the requirements to receive real estate professional tax treatment. I may be mischaracterizing some of this, so your expertise would be greatly appreciated. Hunter, thank you for your question. Now, first, before I answer it, I want to throw out a disclaimer, a big disclaimer, and this area of taxation is extremely complicated, okay? And the complications accelerate the more you go into it. And with that said, what I'm going to discuss here pertains to your question in particular, and it's not going to cover a lot of other aspects that may be applicable. When you're dealing with passive loss rules as they pertain to real estate, there are other considerations such as if you're having short-term rentals, if you're doing self-rental activities or providing substantial services, all those things can complicate matters in this area, and I don't want to make an hour-long video about this right now. I just want to address your questions directly. So with that said, just understand that this discussion is going to be oversimplified, and if anybody's watching this and they want to put any of this information to use, definitely consult with a tax professional to make sure that you stay on the right side of all the rules and regulations that are applicable to your situation. All right, with that out of the way, let's take a closer look at this question. And what I'm going to do, since this area is extremely detailed when it comes to terminology, I'm actually going to edit your question a bit to make sure that we're all talking the same language and make sure that nobody gets confused because of the different terminology that's kind of thrown around sometimes in this area. So, firstly, we want to differentiate net operating losses from losses that may arise from real estate activities. Net operating loss, or NOL, is separate from the discussion of deducting real estate losses and passive losses against your other income. So for purposes of this video, I'm actually going to change this to losses, okay? So we don't confuse anybody by putting NOLs into this. Now, if you have substantial enough losses from real estate activities under certain circumstances, it can create an NOL, but we're getting way too advanced if we start combining this all together, right? So I want to keep this real simple and bite-sized for people. So with that said, let's keep NOLs totally separate, and let's talk about just losses for the moment. All right, so if I have a, all right, so it's here too. So again, we have to be very careful to make sure we're on the same page. So let's call this a loss. In a year, can I carry the losses forward? My understanding is the loss carries forward until you sell real property for a gain. All right, what are we even talking about here? So in this situation, publication 925 is very helpful for us because it outlines the passive activity rules and the loss deduction rules when you have passive activities. And the reason for all of this is that back in the day, you had wealthy people who had income from, let's say, wages, investments, all that good stuff. And also, they had losses from rental activities, other investments that they just put money into that they weren't managing, anything like that. And what happened was that they had massive amounts of income and massive amounts of losses that were offsetting that income, thereby minimizing their tax liability. And that opened up the opportunity for all sorts of tax shelters to come along whereby you put some money in and you just get losses that are being generated on an annual basis that reduce your taxable income without you really doing much or having any skin in the game, so to speak, or putting any real work in. So you have ordinary income taxes being applicable to your wages and interest and things like that. But then that's being offset by all of these losses that are coming through from these investments that you're not actively working and you're not putting in the blood, sweat, and tears, so to speak. Congress did not like this because essentially it was minimizing tax collections. So what they did was put in place passive loss rules that limited the amount of losses that you can deduct in many situations. So when we're talking about passive activities, we're generally referring to things where you make an investment in an activity and you're not working in it on a day-to-day basis. All right. Whereas a non-passive activity would be your wages, where you go to work every day and you are participating in that activity. You're putting in blood, sweat, and tears, so to speak. That's a non-passive activity. So that means you don't have to worry about the passive loss limitations. You can deduct your losses that are non-passive against non-passive income. So when Congress put these limitations in place, you can have a whole bunch of non-passive income, and if you have losses, you have to make sure you classify them correctly, because if they're losses from non-passive activities, then you can generally net that against income from non-passive activities, right? Because you may be working 9 to 5 and receiving a W-2 income, but also you have a side business where you're working nights, you're putting in the effort, you're marketing, you're doing all those business-like activities. It would make sense that if you have $300,000 in wages in a particular year and $100,000 in losses from your side business, that you can offset those and you'd only be taxed on essentially the $200,000 net. All right, doesn't exactly work that way, but that's the idea. The issue arises when you have $300,000 in wages and then you have $100,000 in losses from a passive activity. So you have non-passive income and passive losses. How do you deal with that? All right. And this is what publication 925 delves into. And it's a very specific, very clear document. It has a lot of examples. It's really easy reading and a good place to get started to wrap your head around all these different crazy aspects of the tax code. Now, the passive activity rules have a quirk in there in that rental activities in general are by default considered passive. Now, I have plenty of real estate owner clients that might say, Alex, what are you talking about? Real estate rental activities make me want to pull my hair out. I have to be involved on a day-to-day basis, all of this good stuff. I feel you. But at the same time, you have to recognize that if you're putting out a rental property for rental income, essentially the default treatment is that it's a passive activity. So what's the problem there? The issue is that if you have non-passive income and then losses from your rental activity, you may not be able to deduct those losses against the non-passive income in a particular tax year. You may have to wait till a future year before you can get a tax benefit from those losses. All right? So essentially, that's the entire idea here, is that taxpayers always want to deduct their losses against their non-passive income, but the rules are in place. They're pretty stringent that say, wait a minute, you have non-passive income, you're trying to deduct passive losses. In many cases, you're going to have some hurdles to jump over, and that's what we're going to get into a little bit here to answer your question. Now, by default, real estate activities are passive. So if you have a $100,000 loss from real estate activities and you have $300,000 in wages, which are non-passive, what happens? Similarly, if you don't have that much income, let's say you have $50,000 on the non-passive side and $100,000 losses on the passive side, what happens there? All right. So a few considerations here. I'm going to, again, try to keep this simple, but this does get kind of complex. And one of the considerations first is considering what income is active, what income is passive, because that's going to be the first step into getting into this whole area. So again, if you are looking at wages or self-employment income, things like that, those are considered non-passive in most cases. So you can categorize those. And then if you have the losses from the rental activity, that begins its life as passive until or unless you can prove otherwise. Now, there is a little bit of leeway in this area in that Congress recognized that, hey, we have these mom and pop owners of real estate. They don't have, millions of dollars and thousands of doors, and why don't we put in a tax benefit to allow them, those little mom and pop real estate owners, to get a tax benefit from their losses and not have to wait until a future tax year to deduct those losses. And that is known as the active participation allowance, and you can find that in publication 925. All right, so active participation basically means that you are making decisions on behalf of that property. Now, let's take a look at the exact definition. You may have actively participated if you make management decisions in a significant bona fide sense. Management decisions that count as active participation include approving new tenants, deciding on rental terms, approving expenditures, and similar decisions. So what it's saying is that if you actively participate in a rental activity, then you're allowed up to $25,000 a year that you can deduct of rental losses against your non-passive income. All right? So there's an example here that says the following. Mike, a single taxpayer, had the following income and loss during the year. So they have salary, $42,300, dividends of $300, interest of $1,400, and rental loss of $4,000. Now, we talked about the fact that by default, rental income is considered passive. Same with the rental losses. It's still passive. And in general, you can't deduct passive losses against non-passive income. But there is that sort of mom and pop provision in the tax code that says if you actively participate, you can deduct up to $25,000 of losses from passive activities against your non-passive income. But there are stipulations. Let's read. The rental loss came from a house Mike owned. He advertised and rented the house to the current tenant himself, active participation. He also collected the rents and did the repairs or hired someone to do them. Even though the rental loss is a loss from a passive activity, Mike can use the entire $4,000 loss to offset his other income because he actively participated. So there is an allowance, a little mom and pop allowance I like to refer to it as, that allows up to $25,000 of losses from passive activities to be offset against your non-passive income with regard to a rental property situation. Now, there is a limitation based on your modified adjusted gross income, or MAGI, or MAGI. Let's read. Phaseout Rule. The maximum special allowance of $25,000, $12,500 for married individuals filing separate returns and living apart at all times during the year, is reduced by 50% of the amount of your modified adjusted gross income, MAGI, that's more than $100,000, and the phase out ends at $150,000. So basically, as your modified adjusted gross income goes from $100,000 to $150,000, for each dollar that it exceeds $100,000, you reduce this $25,000 allowance by 50 cents. All right. Essentially, if you, let's say, are at 125 of gross income, all right. So let's do the math on this. So $125,000. All right. And we exceed the $100,000 lower threshold by how much? $25,000. And we see here that it's reduced by 50% of the amount of your MAGI that's more than $100,000. So let's do the math. Times 0.5, 12.5. So in this situation, if we subtract the $25,000 maximum allowance, we're only allowed the $12,500 that we can use to offset against non-passive income. So this is the mom and pop allowance if you actively participate in real estate activities. Now, what if you don't meet this income criteria and you're way above the $150,000 AGI? What happens then? In that case, generally, you still have to defer or suspend the losses to a later date. A lot of people that make a lot of money and have losses from real estate hate this fact, but it kind of is what it is. Now, when can you take those losses, right? Because we said we're deferring them, we're suspending them to a future tax year. When can you take those losses on real estate rental activities that are passive? That occurs when you have a complete disposition of a passive activity. So if you're talking about a single rental property, then once you sell that property, and not a piece of it, but the entire thing, essentially, that is when you can deduct the suspended losses. We say in income taxes that the suspended losses are released in the tax year of disposition of the complete passive activity. So what that means is that you may have a gain on the sale of the rental property, but all of those suspended losses, they are available to offset your non-passive income, not just the capital gains on the sale of the property. All right, this is able to offset all of your other non-passive income. It's powerful, very powerful stuff. But then keep in mind, if you sell a rental property that you've been depreciating over time, you may be subject to what's known as Section 1250 unrecaptured gain. So essentially, the gain that's attributable to depreciation is going to be taxed at up to 25% at the federal level. But at the same time, any of those suspended passive losses are also being released that are going to offset your non-passive income. I know I'm getting kind of technical here, but I told you guys, this gets a little involved. Stay with me. We're going to look at a tax return, and this is going to make a lot more sense. So essentially, if you don't meet this mom and pop provision, you're suspending or you're deferring your losses to the tax year in which there's a complete disposition of a passive activity. Now, there are all sorts of aggregation rules and grouping and things like that. I'm not going to get into it right now. I mean, we could be here for hours discussing all those nuances, but on a sort of basic level, this is how things work. Again, there are other considerations, meaning real estate professional status, and this is something that a lot of people get tripped up by. The reason being is that real estate professional status is a way to avoid the limitations put forth by the passive loss rules, right? Because we want to deduct our losses, and there are a few ways to do that, but the bar is very, very high. Let's read. Real estate professional. Generally, real estate activities are passive activities even if you materially participate in them. However, if you qualified as a real estate professional, rental activities in which you materially participated aren't passive activities. All right. So now we're avoiding that brick wall between non-passive and passive if we can meet the criteria to be a real estate professional, which are stringent, not easy. All right. Don't just think that because you watched a few YouTube videos on real estate, you're a real estate professional. It's not going to cut it. So qualifications to be a real estate professional are as follows. You qualify as a real estate professional for the year if you met both of the following requirements. More than half of the personal services you performed in all trades or businesses during the tax year were performed in real property trades or businesses in which you materially participated. All right, a lot of stipulations in there. Secondly, you perform more than 750 hours of services during the tax year in real property trades or businesses in which you materially participated. Again, very stringent requirements. I've seen a whole lot of taxpayers think they qualify as real estate professionals when in fact they don't. I've seen taxpayers who qualify for real estate professional status, but they aren't able to substantiate it, which can create huge problems because we're talking about big numbers generally. So the first hurdle is meeting the real estate professional qualifications. The second hurdle is being able to substantiate and keeping proper records. If you can get there, more power to you. In that case, these passive loss limitations are not going to be applicable for those tax years in which you qualify. Now, it's on a year-by-year basis, so don't just assume that if you qualified as a real estate professional 1 year, that that's going to be the case for all subsequent tax years, okay? Important consideration. But that's one way to get around the passive loss rules, and we're playing by the rules here. This is just like that mom and pop provision that allows you that up to $25,000 deduction against non-passive income. This allows you to not even worry about that $25,000 limitation. So if you have theoretically $1 million loss from real estate and you're a real estate professional, you can use that to offset your non-passive income. We're just scratching the surface here, just talking in real rudimentary terms. It gets much more complex. So if you're going to rely on any of this, you definitely need to consult with a tax professional before moving forward or making any decisions. With that out of the way, I promise you guys we're going to take a look at how this functions on an actual tax return. All right, so here we're taking a look at a 1040 for 2019. The 2020 tax software is not out yet. And we're looking at this first page. There's a taxpayer with $50,000 in wages, and let's say they also happen to have a real estate rental property. Then there's nothing really going on aside from that on this return. So let's go to the real estate rental section, and let's create some losses and see what happens. So in this case, let's put in $50,000 in advertising expenses. So if we don't have any income, essentially we're just creating a $50,000 loss. If we go back to the 1040, what do you think we're going to see? So we have the $50,000 wages. Good. And then we have a $25,000 negative number here. Where's that coming from? So if we look here, it says that it's coming from Schedule 1. Let's take a look at Schedule 1. Okay. It says here it's coming from Schedule E. Let's take a look at Schedule E. Now, Schedule E is where we report rental income and losses for sole proprietors. And we see that we have advertising of $50,000, no income, so it's creating a $50,000 loss. And then if we see here, it says deductible rental real estate loss after limitation, if any, on Form 8582. Form 8582 happens to be the passive loss limitation form where a lot of this is calculated. Now, it talks about rental real estate activities with active participation. We've covered this. And right here, we can see the $50,000 loss. And if we scroll further down, we see that there is a special allowance for real estate rental activities with active participation. We've covered this, right? So essentially, you have a calculation that examines what the AGI is. So your modified AGI in this case is $50,000. We talked about the threshold being from $100,000 to $150,000 being the cutoff or the phase out. In this case, it's calculating the loss of $25,000. So we're taking that maximum loss, even though we had $50,000 in real estate losses, we're allowed $25,000 to offset other income in this tax year. That's why on Form 1040, we see that there's that negative $25,000 amount, introducing our taxable income. Very nice. If we look at the carryovers, we'll see that there's unallowed passive losses of $25,000. Same at the California level as well. In this case, this is assumed to be a California taxpayer. So essentially, $25,000 of the $50,000 loss is being used to offset income in the current year, and the other $25,000 is being put forward, suspended, deferred, whatever you want to call it, to a later tax year. So you don't lose it, you just get it later on. Now, let's change the scenario a little bit. We talked about that mom and pop provision being applicable for modified AGIs of $100,000 to $150,000. What if you have $300,000 in wages? Let's take a look. All right. So let's change the wages to $300,000. And let's take a look at our return. Again, we have the losses from real estate at $50,000. So if we take a look at the 1040, first of all, what do you think we're going to see? All right. We already talked about the fact that there's a mom and pop provision and what happens if your income exceeds the $150,000 in modified AGI. What do you think we're going to see while I take a quick swig of my wonderful beverage? All right. So let's take a look. We've got the $300,000 in wages. And, whoa, where'd our loss go? We had $25,000 losses before, now we have nothing? Crazy. Let's try to trace this back. Let's look at Schedule. Well, Schedule 1 doesn't even exist on the return anymore. Let's take a look at Schedule E. So we still have the $50,000 loss. And now you see that in box 22 here, it says deductible rental real estate loss after limitation, and there's nothing. What's going on? Let's take a look at 8582. So now on Form 8582, we still see that there's $50,000 in losses from real estate rental activities with active participation. Now, if we look at the special allowance, though, you'll see that the form is taking into account that our modified AGI is $300,000. It's over the $150,000 mark, so that we're getting none of the loss in the current year. All right, it's all being suspended. And where do we see that? So if you go on the latter pages, pages 2 and 3 of Form 8582, you can see some of these amounts. And in this case specifically, we're on page 2. And you'll see that at the worksheet 5, there's allocation of unallowed losses. We'll see rental property, the line that it comes from, the loss, and the unallowed loss in this case is $50,000. All right, so we're not allowed to offset any of our non-passive income with these passive losses in the current year. What's happening in future tax years? Well, if we look on the general information here, we can see that the carryovers to tax year 2020 are the $50,000 in losses. So in this case, we exceed that mom and pop provision with active participation because the modified AGI is over $150,000. Then we have to defer or suspend the entire passive losses until we have adequate losses to offset them. All right. So it is the case that if you have $50,000 in passive income in the next year and you don't dispose of the properties, then you can use the passive losses from this year to offset those. All right. So it's suspended until you have adequate passive income to write off against it, or till there's a complete disposition of the passive activity. Now let's simulate that. Let's go back to the return. Let's go to this depreciation section. And the assumption is that this is a building that was purchased in the year 2000 for $200,000. And now we're going to put in a sale date. So we're in 2019. So let's put in 1/1/2019. All right. And the sale price will be $500,000, whatever. It doesn't really matter for our purposes. The important items here are the fact that we're denoting that this is a complete disposition of a passive activity. Now, there could be a whole textbook on what that means in various situations, if you're grouping, not grouping, if there's a partial sale, all this stuff. But in this case, we're just going to assume that it's a complete disposition. Aside from that, we want to incorporate into the return carried over losses from prior tax years. So we do that here. All right. And in this case, we're just going to keep it simple. So prior year unallowed passive losses. So we're going to pretend that we've had losses in prior tax years that we were not able to deduct. So we suspended them and carried them forward of $80,000. All right. And we're not going to worry about AMT for now. Let's just worry about ordinary income tax. But you may have a different number for AMT purposes. Keep that in mind. So the unallowed passive losses from prior tax years are $80,000. The losses from the current year in 2019 are $50,000. All right, so we got $50,000 and $80,000 that are being carried forward. So let's just add them together. $130,000. So what do you guys think is going to happen on this tax return in 2019? Let's take a look. All right, so going to the 1040. There's going to be a lot of different numbers here now, but we want to focus on the fact that there's still $300,000 in wages. Other income is showing negative $130,000. All right, which is a familiar number because we just calculated that. All right, so let's go to Schedule 1. We see that there's that negative $130,000 from Schedule E. Let's go there. All right, and we have the $50,000 loss that we're being allowed. And here, we're still seeing that there's amounts coming through from Form 8582. So let's take a look at that. All right, so we have real estate activities with active participation, so on and so forth. And we could see that activities with net loss is $50,000. Prior years unallowed losses are $80,000. That is what's giving us the total loss here of the $130,000. All right, so we have the prior year loss, the current year loss. The reason we're taking everything all at once is because there was a complete disposition of a passive activity in the current year. What if it wasn't a complete disposition? What happens then? So in this case, we can take this out of here. And what do you think is going to happen if we dispose of this property? not a complete disposition in the current tax year. It was a passive activity, and now we just have the $50,000 loss from the rental. What happens then? Take a second, think about it, and I'm going to take another swig of my beverage. Don't worry, it's tea, guys. I don't start drinking whiskey until midnight. So let's start analyzing this. Now, we have the same set of facts. It's just not a complete disposition. So we have the $300,000 in wages, and that is it. No losses for us. Let's take a look at Schedule E. We have the $50,000 loss. Let's take a look at 8582. And what's happening here is that we're not being allowed any losses because in Worksheet 5, we can clearly see that the $130,000 is an unallowed loss. And what's going to happen is if we look at the general information screen here, that $130,000 loss is being carried forward to future tax years. Okay, so you can see how this can be very tricky, but extremely powerful from a tax planning perspective, because you may have had a taxpayer that was planning on doing a partial disposition, but you as the tax preparer could say, wait a minute, if you do a complete disposition, here are the extra benefits that you may gain from the passive losses that have been suspended all these years, right? This is how us tax professionals add value for our clients. So in all these scenarios, you could see that there's a lot of twists and turns. I'm still trying to keep it real simple. So again, before you take any of this into account, consult with a tax professional, and a knowledgeable one at that has experience with real estate, because you can see there's a lot of nuances here. Okay, so let's go back to the question. And now I think you guys can tell why I parsed the language so carefully. It's because we want to make sure that we're understanding each other when we're talking about this stuff, because if one person uses one term, another person uses another term, we might have problems. All right, so we finished editing right here. So it says, my understanding is that the loss carries forward until you sell real property for a gain, not necessarily for a gain. All right, you can sell the property for a loss, and still the passive losses will be released to offset non-passive income. All right, so it's not necessarily for a gain. It's having a complete disposition of a passive activity. That's what matters. All right, in which case you can use the suspended loss to offset a gain on the sale of a rental property. To offset, I will edit this to non-passive income. All right. My further understanding is that you can count the NOL. Again, we don't want to use NOL in this context. It has a totally different connotation from a tax perspective. Let's just use losses to make sure that we don't confuse anyone. Against your other W-2 or 1099 income in the year of the loss if, one, you're an active material. See, we got to be very careful here. Active participation, if we go back to publication 925, is its own animal. Active participation isn't the same as material participation, defined later. Active participation is a less stringent standard than material participation. So what we're saying when we phrase it like this is two totally separate things. We want to be careful. So I know what you're getting at. You're going for active participation here. So let's edit that part just so it's very clear. All right. Okay, so now let's reread your question and make sure that we parse the language to make sure we're on the same page and that we're understanding all this crazy stuff, all right? As a follow-up to the capital loss carryover video, I would be interested to see you do a video about losses for a sole prop rental business. For instance, if I have a loss in a year for my residential real property rental business, how do I carry the losses forward? My understanding is that the loss carries forward until you sell real property. We can make that even better, until you completely dispose of a passive activity. In which case, you can use the suspended loss to offset non-passive income. My further understanding is that you can count the losses against your other W-2 or 1099 income in the year of the loss if, one, you're an active participant which quickly phases out from 100 to 150,000 AGI, or you meet the requirements to receive real estate professional tax treatment. So you are correct in that you have that mom and pop allowance if you're an active participant of up to $25,000 in losses that you can offset against non-passive income. And if you meet the requirements to be a real estate professional, then you can simply offset your non-passive income with those losses because they're not passive at that point, all right? The idea was to separate the blood, sweat, and tears activities from the losses from non-blood, sweat, and tears sources in a very crude way, if you want to picture it that way, if that makes it easier to conceptualize. So this is pretty much a rundown, a good overview of this area and how crazy and how quickly it can get crazy. And essentially, here's a handy-dandy flowchart that you can kind of use, or a list of considerations if you'd like, that, again, very oversimplified. But the first question is whether the activity is passive or non-passive that you're involved in, right? You want to be able to separate the income. And then the question is, if you have income from one category versus losses from the other, can you simply offset them, or can you offset a portion of them, or do you have to just suspend the losses until further tax year and so forth? Next, you want to evaluate if you actively participate. We looked at the requirements for active participation, being that you make management decisions, approving new tenants, deciding on rental terms, approving expenditures, and similar decisions. All right, so keep that in mind. That's going to be another factor here in terms of figuring out the tax implications of all of this. Thirdly, you can either deduct the passive losses that are suspended in a year in which there's adequate passive income to offset those losses. So let's say if you started out in a year where you had losses from your one real estate rental property, and then the second year started to produce more income, you can offset that income with those suspended passive losses. Any remaining suspended passive losses, you can offset against non-passive income completely in a year where there's a complete disposition of the passive activity. All right, I'm trying to keep this as simple as possible, but really, in a year where you're going to completely sell the property, then really start thinking about the fact that any previously suspended passive losses are likely going to be released as well, and that's going to affect your tax situation in that tax year in which the disposition occurs. Okay, so we've seen your question, we've tweaked the question, and hopefully this makes it a little bit clearer as far as all of these crazy implications pertaining to passive losses and real estate, active participation, and all this other good stuff. Now, Hunter, hopefully this was helpful. Thank you so much for leaving a comment on my video. And if you guys have your own questions, start leaving them in the comments below. I'm going to start answering them, and it's going to be a beautiful thing. The more answers, the more questions. Before you know it, Dave Ramsey has some serious competition. Am I right? I'm kidding. All right. So with that said, if you found this video helpful, feel free to leave a comment, like the video, subscribe to the channel, smash all those good buttons down there, and share the video, because sharing the wealth is what it's all about. Also, subscribe to the channel because there will be more videos coming. I love making them, so they're definitely not going to stop anytime soon. With that said, hopefully this was helpful. Thanks for watching.